Brought to you by runtogold.com, the premier source for monetary science applied to geopolitical, international, and economic, financial news and events. Welcome back to the 35th episode of the runtogold.com podcast. In this episode, I discuss the Brazilian economy with Contrary Investors Cafe. So, enjoy.
Hello, everyone, and welcome back to Jim, Willie, and Friends. This week we're here with our friend Trace Meyer. Hi, Trace.
Hi, Michelle. How you doing?
I'm doing well. Welcome back. It's been a while since we've had an opportunity to talk with you. You've been off gallivanting around the world. Just got back from South America.
Yep. Just returned a couple days ago. So it's nice to be back in the States where it's warm because it's winter down there now.
Oh. Yeah, I suppose it would be, although it's not something I think about that often. Actually, I was just reading your article on Brazil on your website, and I wondered if your trip south was the reason, what prompted you to write the article on Brazil.
Well, it definitely contributed to it. There have been a lot of very important geopolitical and geostrategic events taking place with Brazil, and since I was down there, I figured I might as well write a little bit about what's going on so that people can have a little bit of the big picture of what's happening.
You know what I find really interesting? We hear the term BRIC tossed around. It's Brazil, Russia, India, and China. And I found it fascinating. It seems like which one of these doesn't belong. It really doesn't seem like Brazil belongs with Russia, India, and China, not in the same area of the world, not really even thought of in the same mindset as the economies, say, in India and Russia, which have been coming up but have been set back a while. Why don't you tell us a little bit about how that fits in altogether?
Yeah, they seem kind of like the odd one out, the one that doesn't fit. But actually, they're right in there, right? They lead it off, and they're a very important part of the BRIC economy.
Why don't you give us a little bit of a background on what you understand about what's in common with these economies and why they're kind of posing, I wouldn't say a threat, but there's something that they're definitely a group of countries that we need to be on the lookout for.
Yeah, well, definitely. So you've got the first two, which are Brazil and Russia. And what Brazil and Russia have in common is that they're both commodity powerhouses. Very large countries geographically, tremendous natural resources, whether it's oil or timber or other commodities, the soft commodities. And then you've got India and China, which are the abundant cheap labor economies. And so these two groups together form the BRIC economies. Now, it's not necessarily that there are any trade agreements in place like Mercosur or ASEAN or like the EU. It's not anything like that, and I really don't see anything like that happening from a political standpoint with these economies. But I do see them integrating a lot more in terms of agreements with their commodities and agreements with how their labor is structured and set up.
Okay. Let's talk a little bit about the commodities. And, I think one thing that I want to make the point of, and you and I chatted about this before, that a lot of people view the United States as the engine that drives the world's economies, and it really isn't the case anymore.
Right. I think it's Peter Schiff. He says, the United States isn't the engine, it's the caboose. And that really is kind of the case, because to use another of Peter's analogies, he talks about everybody helps work and put together a meal, and so the cheap and abundant labor economies like India and China, they're the ones climbing the trees or preparing the food or cooking the food, and then you've got Russia and Brazil who are actually providing the food. They own the trees with the coconuts or whatever it is. And so America's job is to eat the meal. And so everybody thinks, oh, well, the whole economy will be horrible if Americans don't eat the meal. Well, the truth of the matter is that the people who own the trees that provided the food for the meal and the people who prepared the meal, they'll eat the meal. And actually they'd be better off and their standard of living would rise if they just told the Americans that they weren't invited to dinner anymore, unless they brought dessert or something.
So in essence, if these BRIC countries really rallied together and supported one another and excluded America from the picture, they'd all be better off, and we'd be sort of left hanging.
Well, yeah, a little bit. I mean, America's not going to go anywhere. America is at the center of Atlantic and Pacific trade. It's in a very dominant position. We control the oceans. So, I mean, America isn't not going, they'll still be invited to dinner. They just might get a smaller portion, while the people who provided the food and the people who cooked it will then, they'll eat a little bit more. Because right now we kind of just, they provide all the food and they prepare it, and we just leave them the table scraps. That's how our world reserve currency, the Federal Reserve Note dollar, has worked. And so I think that they're starting to wake up and realizing that this isn't such a great deal for them or their citizens, and they're starting to plan in a little bit more of a geopolitical and geostrategic sense to retain a little bit more of that purchasing power or that meal for their own people.
Why don't you talk a little bit about the significance of the relationships between, like, Brazil and China and, some of the other BRIC countries, and how those are developing and what that means for the U.S.?
Well, there's big happenings going on between China and South America. We have Argentina and Brazil. They recently engaged in a currency swap of about $1.5 billion, and then Argentina also signed a $10 billion currency swap with China. And China is also engaging in lots of trade with Brazil. So what's happening is that they're trying to the Chinese are trying to get some of the currency market share that the dollar has down there. Instead of holding dollars, they want them to hold yuans, and they want to start settling their trades in yuan and things like that. And so what that'll do is that'll help increase the liquidity of the yuan, which will increase its value, while the Federal Reserve Note dollar, it'll lose some of its liquidity and therefore lose some of its purchasing power. So that's what's going on, is China is trying to move in, and they're trying to, I think, hedge a lot of their dollar exposure with these commodities that come from the commodity producers like Russia or Brazil.
Now, do you think that is, in essence, positioning the yuan to take over as a world reserve currency?
Well, I don't know. I don't necessarily think the yuan will take over as a world reserve currency, but I think that the Chinese are trying to have it become one of the major currencies. So we've got the Federal Reserve Note dollar, we've got the euro, the yen, the British pound. I think that they want to move it up into one of those top tiers among the major world currencies. So to do that, they're forming relationships with these countries that provide a lot of the commodities and natural resources, because ultimately a currency is only good for what it will buy. So they want to make sure that their yuan will buy oil or timber or cattle or soybeans or whatever it is that Argentina or Brazil or Russia produces, because they want these real things, these real goods, particularly food. They want to make sure that they have food for their people.
Well, that makes sense. So let's go back to Brazil after I diverted us off to China's yuan, and talk about how they're, some of the commodities that they have and how, they're working the trade agreements.
Well, Brazil is very interesting and unique in the fact that it's down there by the Amazon, the equator, and so they have a lot of growing seasons, and they have very rich and fertile soil. So they're able to in some cases, they're able to have 4 growing seasons where there's only 1 growing season in like a similar place in North America, for example. So they're able to grow their trees a lot faster. They're able to grow their wheat a lot faster. And what this does is Brazil really becomes kind of like a breadbasket for the world. They produce a lot of the food. Well, we saw this last year. There were some shortages of rice and wheat. And the first thing that happened is the countries began to engage in protectionism. And 29 countries blocked their wheat and rice exports. And Brazil was one of those countries. They suspended 500,000 tons of grain exports. And so this is a theme that I think we're going to see, is that countries want to make sure that they have the basics for their people. They want to make sure that they have the food. And Brazil, as a large commodity producer, they're self-sufficient in that area. They're able to call their own shots because they have the food. And that puts them in a very powerful bargaining position, and especially with a country like China, who's trying to feed 1 billion people. You know, Brazil is one of the largest countries in the world geographically, but it only has 200 million people. There are about 7 times as many people in China as there are in Brazil, and yet Brazil is able to produce all of this excess food. So it puts Brazil in a very strong bargaining position, as opposed to somebody like a Japan, where if they don't have imports of food coming in, they'll starve to death in 6 weeks. So Brazil is fortunately not in that position, and it lends them a lot of stability politically because they have the food, even though they are South American, and the South Americans are kind of a boiling pot, boiling politically, but they do have the food and things, so it keeps their populations pretty safe and secure in that sense.
Mm-hmm. You mentioned in your article that the Brazil's president was visiting Turkey and China and Saudi Arabia. Now, what's the significance of Saudi Arabia in this?
Well, Saudi Arabia is a large oil producer, but what we're seeing is that OPEC is losing a lot of their clout, and Saudi Arabia particularly has most likely passed peak oil production as a country. And so they're going to increasingly lose a lot of their clout in the oil market. And I think Brazil, behind the closed doors, Brazil might be letting them know that, hey, you're not the only game in town anymore as far as who can set the oil price. So we got lots of oil, we produce lots of oil, so let's be friends, and perhaps they're working out some of those changes that'll be happening to the oil market as far as production goes, because of Saudi Arabia's declining production because of the depletion of their oil fields. Because most of their oil majors, whether it's the Ghawar field or some of their other super large fields, they're beginning decline at a rapid rate because of how they had tried to recover the oil a lot quicker. So they're declining. Some of them are 8% per year. So Saudi Arabia is going to rapidly be losing a lot of its clout and influence. And of course, the Saudi Arabian and American relationship that points to decreased influence of the Americans in the worldwide oil market. So I think Brazil is probably over there talking about some of these things behind closed doors and seeing how they wanted to move forward on probably good, friendly terms, because Brazil is not a very aggressive nation.
Well, and sometimes it's the quiet, meek ones that you have to watch out for, because they accomplish things without garnering a lot of attention.
Yeah, I mean, whether it's Brazil or China, both of them trying to accomplish things through diplomacy and through contract rather than occupation and invasion, for example, or other subversive tactics. Because that's another thing with South America is that there's a very strong anti-American sentiment in lots of parts of South America, and it's embodied in this figure of Che Guevara, who was a revolutionary who crusaded against the American corporations because they were abusing the South Americans. And actually, while I was down there in South America, I decided, I want to go see the Capitol building. It was a couple blocks from my hotel. So I get out, and I'm just wandering around the streets of Buenos Aires in Argentina, and I wander into a 30,000-person protest, and they've all got these Che Guevara banners and things like that. And so I was quite surprised to see that this person who had been executed 40 years ago still had such a strong influence in the political arena down there. His ideas did. And so there is kind of this anti-American sentiment down there because they feel they've been abused by the large multinational corporations or whatnot. And so they're forming these relationships with other countries that they feel, for whatever reason, treat them better.
It's interesting. I want to touch back on that, but I want to go back before we move on to that topic. You mentioned Brazil and China and oil, and in your article you were talking about a new agreement between Brazil and China where Brazil guaranteed China, oil at current market prices, and I wanted to talk a little bit about that.
Yes, back in, let's see, where is it? They'd been talking about this for a couple months. I wrote an article about it back in February, but just today, on May 19th, they signed 13 accords, and these agreements are regarding oil exploration and crude trade. And so Petrobras, which is Brazil's super oil major, they're going to be working with the Chinese oil companies and supplying 150,000 to 200,000 barrels a day of oil to China. So this is a way that China is able to secure some of their oil needs.
And, I don't know about everybody else, but I never really thought about oil Brazil as a major oil producer. You always hear about OPEC in the Middle East. South America just doesn't seem to be on that radar. But apparently, there definitely has a resource down there that we aren't aware of.
Yes, and a lot of this oil is offshore, so they do need some of the technology of our oil companies in order to really get a hold of it. But they're a very large oil producer, and they're building, as Dwayne said before the show, they're building a big refinery down there. It's just massive, and so they're definitely a player when it comes to producing oil. And another thing that adds to their strength is that they are net oil exporters versus net oil importers. For example, the United States, we use 28 million barrels a day, but we only produce a fraction of that. And so with Brazil, they have this surplus of oil, which, if supplies get tight, they can always keep it for themselves, kind of like they did with the wheat.
Okay, let's go back to what you were talking about with the anti-American sentiment and Che Guevara. I do find it interesting that after, 40 years after he was killed, that he still seems to be a symbol of that rebellion, of that anti-American sentiment. And I guess my question is, do you think that that's something that just is going to continue to bubble under the surface, or do you think that could start to boil over?
Well, it's not so much under the surface. 30,000-person protests out in their front of their Capitol building, that shows some displeasure. But I don't think they were, protesting the American corporations. But yeah, I think that it's there because the American empire has created some enemies. We've got enemies in the Middle East that'll strap bombs on themselves and try to blow us up. And so I don't think it's that bad down there in most parts of South America yet. But there are examples of countries like, I think it was Bolivia, that actually kicked out the U.S. ambassadors. Like, get out of our country. We don't want you here. And so there is, some of them are even severing their diplomatic ties with the U.S. They're just fed up with the heavy-handed tactics of a failing empire. So I think that as the U.S. empire continues to weaken, that it'll leave some space and vacuum in South America, and so those countries down there, they'll expand to fill that void, probably by letting in China or some of these other large regional players.
Well, I want to move on and talk about some other things happening here with the prices of the precious metals and gold. But before we do move on, is there anything, any other impressions from South America and Brazil that we haven't touched on today that you wanted to talk about?
Oh, they got some of the best beef in the world. So if anyone's considering a trip, South America is a great place. I really like it. I'd recommend Argentina is a great place to go down there. It's relatively cheap to get around, and you can experience great, just a lot of culture and things like that. And it helps to get out of one's comfort shell and to go down and travel and see the world, because then you have a perspective that you can't really get just from reading words on a screen or listening to a podcast. I mean, you go down and you go to a tango show, or you go skiing in Bariloche, which is as nice as Lake Tahoe, with powder as nice as Park City. So, I mean, a lot of people think of South America as a jungle, and they're going to get bit by a bunch of bugs or spiders or whatever. But the truth of the matter is that some of these cities are as nice or even nicer than parts of Europe, like Paris, for example. I'd rather spend time in South America than in Paris, and I've been to both several times. So a lot of people think it's a jungle, but it isn't so much a jungle. But at the same time, there is a little bit of safety concerns in some cities like Sao Paulo or Rio. So, make sure you do your homework. But it's a great place to go down and just see what's happening.
Well, I think it's important that, we start thinking about, the globe, and it's that people think about Brazil as a jungle, and there's a lot of misconceptions, that it's not just the Amazon and crocodiles. There's, some very beautiful cities and beaches, definitely some beautiful vacation spots in South America.
Right.
All right, well, now that we've wrapped that up, I really want to move on to, the uptrends in gold and silver and the precious metals right now, because it really is starting to look very promising, isn't it?
Oh yeah, especially if you look at the gold to silver ratio, it's really strengthened a bit, which shows that there's some legs to this rally.
I know. I was just looking at it. It looks like gold's at 926.50 as we're speaking right now, and what was it? Just 2 weeks ago, it was moving downward again. It had a little rally and then it was moving downward, and kind of wondered whether it was going to start back up again, but now that it's started back up, it's just continuing to rise pretty much on a daily basis.
Yeah, which is, I think part of it's seasonal. Gold usually will rise May, and then it'll be a little slow throughout the summer. But during the summer, it usually kind of is very mellow, but there's a lot of uncertainty in the markets, and I think that some of the really big hedge funds are starting to sniff out this opportunity in the gold market. They've honed in on GATA's beacon. And Adam Fleming of Fleming and Partners from Standard Chartered Bank, he had the GATA delegation over to London, and they had 80 investment houses there to listen to them. And they talked about, ironically, my article about the GLD ETF and how they don't really have the gold, and yet we see some of these big hedge funds, like John Paulson's hedge fund, has 8.7% of the GLD ETF. And so I think these big hedge funds they're starting to call the central bank's bluff and say, well, give me the metal in my hand. And as I mentioned in my article, the Deutsche Bank had to get bailed out by the ECB. They had to deliver a bunch of gold, and the very same day they had to deliver the gold on the COMEX, the ECB sold 38 tons. So I think that the hedge funds are starting to call the central bank's bluff and demand the physical gold. And so if there could be a very explosive move really at any time if there is a failure to deliver on any of these major exchanges, whether it's the COMEX or the LBMA or whoever, because there should absolutely be no reason for gold to ever failure to deliver because of the above ground stockpiles. And so even though we've seen the backwardation filter off, there still is this demand for physical delivery. And so I think the central banks are bleeding a lot more gold than they are going to be able to sustain. So it's going to be getting pretty interesting, especially when the next round of credit shocks come from, say, a GM bankruptcy.
Right, which is definitely in the works, I think. It looks inevitable.
Yeah, and I mean, there's a lot of credit default swaps on that, and like Chrysler just declared bankruptcy, and I mean, the job market is, it's slowed down. We're only losing 500,000 jobs a month now. It's good news. We've got green shoots, but there aren't any green shoots in North America. All the green shoots are growing down in the Amazon, and they're growing 4 times as fast because they have 4 times as many seasons to grow
right.
in. So it's they're trying to spin it and make it positive up here, but all of it is really North America is kind of the caboose on the train, and so it's not any time the currency has these problems, it's going to be bullish for the gold price in that currency. And I showed how even in the Brazilian real, gold has performed extremely well. So it's getting everybody should at least own some of the physical metal that they've either taken possession of themselves or through a trusted third party, because who knows? It'll probably, if they can keep control of the market, it'll just kind of float up and down and probably down because of the gold price suppression scheme. But that should be looked upon as an opportunity, because we see OPEC, they own a lot of oil, so they run a cartel to keep the price up. Well, the central banks, they own a lot of gold, but they run a cartel to keep the price down. And why is that? Because they want to keep their fiat paper franchises attractive. And so the strong dollar policy is all about keeping that gold price suppressed. But the Achilles heel is the physical gold demand. And so, anyone who wants to buy something, well, they want it to be at a lower price. And so I look at gold as a tremendous bargain because the central banks have been keeping its price suppressed for so long. And so I just keep accumulating physical ounces on a monthly basis because it's a great deal.
Well, and even people who can't necessarily continue to stockpile, gold, silver is an amazing investment still. It's up to over 14 an ounce, and doesn't seem to be losing, its ability to climb either. But, that you talked about the ratio of gold or of silver to gold is starting to tighten up. I think that's even got a farther way to go than gold in the short term.
Oh, yeah. Silver probably, as far as increasing your purchasing power, silver will probably be even a better bet as we see this fiat currency system as the springs keep coming unwound and the duct tape loosens on this claptrap contraption. There's going to be a lot of upside with silver because silver, like gold, is money. And the ratio on silver right now is 66, and for 3 years there, 2004, 2005, 2006, 2000, the ratio was about 55. So there's a lot of upside potential to silver just from closing the ratio to more historic norms.
And just about everybody that we talk to has been saying, for gold and silver both, the looking at what $1,200, $1,200 to $1,500 gold is not, out of the question, or $25 to $30 silver is not out of the question. And when you look at what's been happening, that looks like it could be a real possibility.
Yeah, I mean, it's always difficult trying to predict a price with this illusion, because the illusion means absolutely nothing. But so I like to look at it in terms of other key ratios, like the Dow to gold ratio, for example, or the Dow to the average American house ratio. And so, I mean, currently the Dow gold ratio is about 9 ounces to buy the Dow, and I think we'll see that go even lower this year, perhaps 5 to 6 ounces. And so, I mean, we don't necessarily know if that'll be $1,250 gold and 6,000 on the Dow, or whether it'll be significantly higher. But the key issue is in that valuation, in being able to perform that mental valuation and being able to price things effectively. And that'll help you retain purchasing power, because even if you hold some of the Dow and the Dow goes up 10%, if gold went up 20%, then you actually lost purchasing power holding the Dow, even though it went up in terms of the illusion. And so that's what I really try to focus on my website, is being able to perform these mental calculations of value in a reliable currency like gold.
Which makes complete sense. I'm glad you brought up your website, because as we wrap up today, I want you to tell us a little bit about the site and also about your book.
Oh, yes, I just finished my book. It's called The Great Credit Contraction. And in the book, I march through how we got to this current mess that we're in, the inflationary credit expansion that went on for hundreds of years, and how it culminated and, according to basic economic law, has begun to fail. And then I give some suggestions on how to protect and preserve wealth and even generate wealth during this type of an environment. And then on my website, runtogold.com, I take monetary science and apply it to current events. So there will be articles like this one on Brazil, or there will be an article on derivatives, or any number of topics. I write about all types of things, like the gold and silver ETFs. So it's always a good resource. Never quite know exactly what you're going to get, but it's for the most part, I try to talk about the monetary role of gold there. So, and it's always an interesting read.
It certainly is. I enjoy your writing very much, and I've learned quite a bit from visiting the site, so I encourage our listeners to do that. Trace, I'm really glad that we had an opportunity to talk with you. We missed you while you were in South America, and we will look forward to having you back again next month.
Okay, thank you, Michelle.
You take care.
You too.
You've been listening to the RunToGold.com podcast, the premier source for applied monetary science on the web.